Cost accounting for a process costing, T accounts, and income statement impact. This is Ken Boyd, the owner of St. Louis Test Preparation. Here's our Facebook page, our email, and our phone number. And I'd like to jump over to Excel and explain a chart that I've created for a student called Flow of Manufacturing Costs. And we have T accounts on here to explain process costing. The first thing I'd like to point out is that almost all of these accounts, direct labor, material control, the manufacturing overhead accounts, the finished good account, and the work in process account are all subcategories of inventory. All of these accounts that I just identified are balance sheet accounts related to inventory. The control accounts for direct labor, materials, and overhead do not end up in the financial statements. These control accounts are temporary accounts that don't end up in the financial statement. And they exist because they account for costs that have not been yet added to production, and then they're credited when the costs go out. So the first step in our process is we spend money on labor, materials, and overhead before we even apply those costs anywhere. So for example, we spend $150,000 on labor and we pay out cash. That's a credit. We have a beginning balance in material controls. We spend more money on materials and that's a credit. And you could also assume that we spent some money on manufacturing overhead. 2 and 3 bring up two terms that I think are very important to distinguish with cost accounting. Number 2 says we trace direct material and direct labors to production. We're specific. If it's Levi jeans, for example, we know how much we paid somebody to run the sewing machine for the jeans, and we know how much we paid for the denim and how much denim we used for a pair of jeans. So we trace those direct costs. Those costs we've nailed down. On the other hand, we apply overhead, which is an indirect cost, and the way we apply it is based on a predetermined overhead rate, where we take the check that we wrote that we expect to write for overhead, and we assign it based on an activity level. We apply it, based on an activity level. And the most common activity levels you'll see used are direct labor hours and machine hours because we figure those levels of activity are driving the cost. So what we see in the overhead allocated account is $160,000 in brown applied because it was used in production. So we credit the overhead account to reduce it, and we debit an account called work in process. And work in process is defined as goods that are partially completed. Goods that are partially completed. If you can imagine opening the doors of the factory on the first day of the month, if there's a pile of Levi blue jeans that aren't fully sewn together yet, or maybe they're sewn but not dyed the right color, they're not finished, they've incurred costs that we call work in process. So not only with overhead applied, but also direct labor, we credit the account to reduce it for what we used in production, and we debit work in process, D-labor for direct labor. Material control, we use $38,750. We credit the material control account and we debit the direct material account. So if we take our beginning balance and work in process, what we found when we opened the factory door, and then we have debits for labor, material, and overhead. There's another term called conversion costs, and we define that as the cost to convert the direct material, denim for the Levi factory, into a final product. And the costs incurred are the direct labor, $141,250, and the $160,000 in overhead. So if you're asked about conversion costs, that's what that represents. We move from work in process So we've talked about how work in process gets debited and increased. So now what happens in the next step? Well, the next step is that once we've recognized the cost of goods in process, the goods are going to be finished, which brings us to step 5 and 4 and 5. We recognize the cost of goods completed by moving it out of work in process by crediting the number in blue, 376,600. Work in process and asset account as part of inventory gets credited to get it reduced, and we debit an account called finished goods. So we can see that the debit, the 376,600, comes out of work in process. So those would be completed goods that are packed up and ready to be sold to someone that are in the factory. And finally, step 5, the finished goods are sold, so we reduce the asset account and inventory account called finished goods. We credit that account to reduce it in red, 378,500. And we increase an account called cost of sales, and this is no longer an asset account, it's an expense account. And so that's how the process goes from work in process, partially completed, finished goods, completed but not sold, cost of sales, completed and sold. And you'll see that when we have cost of sales, we make a couple of journal entries. We debit cost of sales to increase it, it's an expense account, and we reduce inventory by crediting to represent what we took off the shelf. We have a sale or revenue, which is a credit, and we have either cash that we got or a receivable for what we sold. Here's some other terminology up above. If we take the beginning balance of fixed goods, we add in cost of goods manufactured, which is that amount that came in from work in process. If we add those two together, we get goods available for sale. And I always try to explain that goods available for sale, those balances only end up in one of two places. They're either sold, they end up in cost of goods sold, 378,500, and we saw that amount coming out of finished goods and into cost of sales. And if they're not sold, then the difference between goods available for sale, the 403,500 in red, and the cost of sales, 378,500, the difference is what remains on the shelf. It's an ending balance in finished goods, which really means it's an ending balance in inventory. And finally, you can see that we have a difference between the manufacturing overhead that was applied by increasing work in process, the 160,000, and what we actually wrote a check for in manufacturing overhead control. There's a typo there. We wrote a check for 170, which increased manufacturing overhead control by debiting. We only allocated 160, so we're 10,000 short. We should have allocated 10,000 more. So the way we account for that is we close the underapplied factory overhead, we didn't apply enough, by increasing costs of sales because our expenses are too low. So we debit the manufacturing overhead allocated account, so that account debit and credit goes to 0. That's a debit of 160. The manufacturing overhead control gets credited, so that debit credit, the net balance also goes to 0. And the difference between the overhead allocated and the overhead control entry is a difference of 10,000, and that's a debit that goes to cost of sales. So we increase the cost of sales for the underapplied overhead, and it's underapplied because the check that we wrote, 170, that debit is more than the amount that we applied credit. That's the end of Cost Accounting 4A. You'll see more videos that are not on the web page on the website, which lists videos by topic. You can access either by spreadsheet templates or the videos themselves. Our YouTube channel, Ken Boyd STL, all one word. You can email me for a complete list of our videos on YouTube. For live tutoring and chat sessions, stltest.net is the website. Here's our email and our phone number. Thanks very much, and we'll see you next time.